Hi everyone, I'm Jackie Quackenbush, and in our report, we decided to go over the coronavirus and its impacts not only on healthcare systems, but in financial markets and institutions all over the world. With looking at the potential financial crisis that we may find ourselves in, specifically pertaining to real estate, it is important to consider all that will be involved and impacted, both positively and negatively. In this analysis, we address the concerns and potential investment opportunities that should be considered by home buyers, mortgage banks, and real estate company executives, and finally, federal housing policymakers.
Hi, my name is Michael Labor, and I will be talking about individual home buyers and the residential mortgage industry. The COVID-19 pandemic has made a huge impact on the residential mortgage industry. Due to widespread quarantines, business closures, and job losses, homeowners are unable to pay their mortgages. In addition to the lack of income, homeowners are not able to undergo any type of real estate investment, whether that be a personal residence house or a rental property. This will lead to a long-term effect on property values, which can cause problems for homeowners who are planning on refinancing or for those using their capital appreciation for their retirement or other reasons. To an extremity more severe than losing potential income is foreclosure. Homeowners are in fear of losing their investments that they have worked so hard to purchase. However, there has been government intervention to help mitigate the risk of foreclosure. Federal bank regulatory agencies such as the Consumer Financial Protection Bureau and the Conference of State Bank Supervisors have issued an interagency statement encouraging financial institutions to work constructively with borrowers affected by COVID-19. Loan modifications are supposed to improve the performance of the loan and to reduce and prevent borrower harm. Borrowers who are up to date with their debt affected by the pandemic are granted relief, which includes deferrals, fee waivers, and extensions of repayment. Fannie Mae and Freddie Mac are suspending all foreclosures and evictions for at least 60 days. These suspensions include primary, secondary, and investment properties that have mortgages backed by the government. The Department of Housing and Urban Development have taken similar measures to reduce the possibility of foreclosures. The intervention from these government agencies is a necessity to help protect borrowers' investments and homeowners. In addition to the help from government agencies, banks are also helping homeowners in a number of ways as well, specifically with liquidity. These programs are to help borrowers by suspending payment obligations until their income normalizes. Banks are also encouraging a greater access to cash for customers by increasing the daily ATM withdrawal amount and are being more lenient on cash checking requirements. These new changes being made are a way to mitigate risk associated with delinquencies and risk of bad credit reporting. Going along with individual homeowner issues associated with delinquencies and foreclosures, COVID-19 will impact home buyers' preferences in housing. People who are currently renting and have been saving for a down payment on a house will likely have to delay their investment due to the lack of income they are currently experiencing. Some people may choose to rent for longer because they do not want to buy a property as likely going to go down in value. On the other hand, with mortgage interest rates falling nearly to 3%, home buyers may want to enter the market looking for a good deal while prices are low. According to an article from the National Association of Realtors, the one potential conundrum for lower mortgage interest rates is that it could create a slippery slope where more buyers enter the market trying to get a good deal, allowing sellers to jack up their prices. With the low interest rates, refinancing can help homeowners pay down their debt faster if their income allows. Thank you.
Hi, my name is Sky Crane, and I'm going to be talking about mortgage banks and mortgage lenders. So mortgage lenders are impacted by the novel coronavirus through the CARES Act. The CARES Act was created by the Trump administration in response to COVID-19, and it impacts the mortgage lenders in a few different ways. It prevents lenders from beginning foreclosure proceedings on federally backed loans for at least 60 days after March 18th, 2020. This is a big deal because mortgage lenders are not receiving the payment that they originally were contracted for in their mortgage agreement and mortgage term contract. Clients are defaulting on their payments, some more than others, but a lot of them are, and most of them are applying for unemployment. It also impacts the mortgage lender by enabling homeowners who are struggling financially due to the pandemic. They can apply for a forbearance of up to 180 days, or they can look at deferment options if they have private loans. This pandemic honestly has drastically changed the operating chain during this time for them. It makes it more complicated to decipher or decide who is going to receive a mortgage or a loan and who's not to receive a mortgage. Mortgage lenders are adjusting standards in response to the markets because it is affecting them negatively. They are struggling, and therefore they're changing their standards and making it a little bit tougher to get a mortgage at this time because of everyone that is defaulting. The biggest thing is that the biggest change here is, as we saw in the movie The Inside Job, in the 2007 to 2009 financial crisis, this policy was not there at all, and it was not implemented. And therefore, a ton of these families ended up on the streets. Their lives have been completely turned upside down, and it was years before they were able to get back on their feet. So I think this, even though that the CARES Act does negatively impact the financial markets and mortgage lenders, I believe that for communities and families and livelihood in general, along with America being the way it is, I think it's positively impacting communities and all those around them.
Hi everyone, I'm Jackie Quackenbush, and in our report, I decided to cover the impacts of the coronavirus on real estate company executives. So the biggest comparison that I saw throughout my research was the comparison between the 2008 financial crisis and the current crisis that we're finding ourselves in. The biggest difference that I found was that in 2008, there was a lot of subprime mortgage lending going on, as well as too little supply. That is the exact opposite of what we have now. Many real estate company executives predict that there's an anticipation that real estate will continue to go back up to where it was, if not better, before this crisis. Additionally, there has been an inability to close housing contracts without in-person contact. This is due to our no-touch world that we're currently living in. And due to this, many real estate company executives have bought in new technology to help with virtual tours, notarizations, and electronic closings. During this time as well, many real estate company executives have been trying to rescue deals rather than procure them. Many firms have also adopted the policy of no more open houses. This again has to do with the no-touch world, which makes it even more challenging for them to get offers on their properties. Many home buyers don't want to put offers down on houses that they've never seen in person. Additionally, I wanted to cover real estate developers and company executives and their impact on coronavirus. Many real estate developers have had to pause construction because banks are afraid that they might not be able to cover their mortgage payments once this is all over. This is due to decreasing demand and oversupply. So they pause construction, and many are renegotiating maturing loans and source cash to recapitalize on their buildings.
Hi, my name is Tatum Johnson, and I will be discussing how COVID-19 is impacting federal housing policymakers. As my colleagues have already addressed, the current administration has responded to the COVID-19 crisis with the Corona Aid, Relief, and Economic Securities Act, or CARES. In Section 4023 and 4024, the Act calls for mortgage forbearance forgiveness and an eviction moratorium. This would not be reported to credit institutions on behalf of the homeowner or tenant. Section 1102 and 1106 call for a payment protection program, a government loan program for small businesses for up to $10 million for those businesses to keep paying their employees, rent, and other miscellaneous bills. This helps commercial tenants pay their rent if possible, meaning landlords and property managers can still get parts of their rental income. This also would help small real estate companies get loans if their incoming cash flows have been hindered so they can still make their payments. CARES Act does a great job at addressing the near future, but policymakers need to be thinking as long-term as possible. Only 30% of mortgages are backed by the CARES Act, but if this crisis is going on for much longer, can the government let 30% of mortgage owners foreclose on their properties consciously. And also, when the 180 days is up with the CARES Act, there are currently no plans for that as to how the banks and landlords can ask for those 6 months of payments. They could theoretically ask for all of them upfront at that point in time. So that would need to be addressed as well by housing policy. And also, if mortgages are not being paid at this point in time, our mortgage-backed securities really safe financial instruments. These decisions are virtually impossible to make at this moment because no one knows how long this crisis will be going on for, but our federal policymakers will having to be making the best decisions for our citizens, businesses, and financial institutions as a whole as we move forward with this coronavirus situation.
In conclusion, as the virus spreads throughout our country and those around us, the analysis of the economy becomes essential when determining what actions to take in the future. These actions can impact our community for years to come and therefore need to be chosen with great certainty and confidence that it will positively impact those involved. The coronavirus has increased the unemployment rate drastically, which combined with other decisions made by our government has created a huge problem within the real estate financial market. As this pandemic continues to be an enigma, it is important to continue to collect data and analyze the economy as it continues to change daily. Staying informed is the greatest tool we have currently and will continue to be pertinent in the reconstruction of the impacted markets. Thank you.